In this video, I'm going to share with you the 2 things you need to do to start investing as a teenager. Knowing what I know today, these are the same things that I would do if I was able to travel back in time and start investing again. So in other words, this would be the video that I would have loved that somebody showed me when I was 15 years old. If this is your first time on my channel, my name is Ricardo Garcia, and in today's video, you're going to learn why investing in companies like Amazon or Facebook might not be the best way for you to grow your money. So keep watching. If you're a teenager, or even if you are in your early 20s, you have something that most people don't have, which is time. And with time, you can take advantage of compound interest and make yourself a fortune. If you don't know what compound interest is, I'm gonna show you something that I wish somebody showed me when I was back in high school. I want you to imagine the following scenario. We have John, Emma, and Adam. 3 very good friends who are 15 years old and sit down together for lunch every recess. One time, as they're eating lunch, Adam starts telling them how his brother Kyle bought some Amazon stock a couple years ago and he doubled his money already. So the 3 of them get all excited and they decide they want to start investing as soon as they can. Motivated by the story that Adam told them, when John gets home that afternoon, he starts reading articles on the internet about stocks and he decides he wants to start investing as well. So John gets his parents on board and they help him open an investing account, and a week later he starts contributing just over $150 a month, which sums up to about $2,000 every year. He puts his money on an index fund that gets him 10% return every single year. And then he committed himself to invest another $2,000 every year from now on. Emma, on the other hand, decided she wanted to wait a little bit before she started to invest. She wanted to get into an Ivy League school after graduating from high school, so she put her entire focus on achieving her goal and left investing for a little bit later on. When she turned 21, she finally decided it was time to start investing. So she called John, asked him for advice, and after the call, she decided to invest the same amount as him, $2,000 every year, and she put her money on the same index fund that yielded John 10% every year. Now, on the other hand, we have Adam. Adam brought up the conversation about investing during lunch when they were in high school, but he told himself that it wouldn't hurt him to wait a little bit longer before starting to invest. Now Adam is 30, he's married, and he wants to start a family soon. So he knows that the adult thing to do is to start thinking about his family's financial future. So he finally decides that now is the time to start investing. Since he feels he's starting out a little bit later than his high school friends, he wants to play catch up and commits to investing double the amount that John and Emma are investing every year. He commits to throwing in $4,000 a year and he gets the same 10% return that his friends get. So we're gonna fast forward 3.5 decades. Now John, Emma, and Adam are 65 years old. One afternoon, they decide to get together to catch up over a cup of coffee. And they remembered that conversation about investing they had over 50 years ago. So they all share their investing stories and decide to compare their investment accounts. So who do you think has more in it? John, who started when he was 15 and ended up investing $100,000 over a period of 50 years? Or Emma, who started investing when she was 21 and she contributed a total of $88,000 over 44 years? Or Adam, who started later than them, but managed to contribute $140,000 over 35 years. Remember that the 3 of them got the same annual return of 10%. Well, Adam, who contributed the most out of the 3, ended up with almost $1.2 million. Emma contributed almost half the amount that Adam did, but she started 9 years before him and ended up with over $1.4 million. And last but not least, John, who was the first who started investing, contributed $2,000 every year for the last 50 years, and he ended up with almost $2.6 million. That's impressive, right? Well, if you start early, that's what compound interest can do for you. If you have time and a good rate of return, even if you put little money every year, you'll end up with a fortune. So now that you know why you need to start investing early, let's get on to the how. How do you start investing if you're a teenager? Well, the first thing you have to do is open a Roth IRA account. A Roth IRA isn't an investment in itself, but it's a type of account that will hold your investments. Just like in a brokerage account, in a Roth IRA account, you're free to choose where you want to invest your money. You can buy anything from stocks to bonds to mutual funds. All the money that you would invest in a Roth IRA account or a brokerage account would have to be after-tax money, meaning that every time you get a paycheck, you pay your taxes and then you use that money to invest. But the main difference between those accounts is that in a brokerage account, any profit that you make, you have to pay taxes on. Instead, in a Roth IRA account, any profit that you make is yours to keep. You have to pay 0 taxes on that. So basically, your money grows tax-free. Let's say you have $5,000 saved now and you want to invest that money. Let's compare what happens if you put that money in a brokerage account versus a Roth IRA account using the same variables. $5,000 as your initial investment, 10% rate of return, and 40 years until you withdraw the funds. Both accounts would grow to over $226,000. But if you invested your money on a regular brokerage account, then you would have to pay taxes on your profits when you take the money out. Your profit would be upwards of $221,000, and you could assume that you have to pay around 20% in taxes. So you'll be giving away almost $45,000. On the other hand, if you invested that money in a Roth IRA account, your profits would be exempt of any taxes. So you will get to keep the $226,000 in full. And I don't know about you, but I prefer option number 2. That's why a Roth IRA is perfect for young investors. Because while you're young, you're probably earning low income, which puts you in a lower tax bracket. So you'll be paying close to nothing on taxes now on the money you're investing, and that money grows tax-free, as long as you wait until age 59 and a half to withdraw it. If you're over the age of 18, most financial institutions will allow you to open a Roth IRA account on your own. But if you're younger than that and you want to begin investing, I suggest that you go and talk to your parents about it. Your parents can open what is known as a Custodial Roth IRA account for you. On this type of account, your parents or guardians will have to make the actual trades for you, and they will retain management control over the account. However, you can be part of the investment process. You can select your asset allocations and in which stocks you would like to invest in. All you have to do is tell your parents what stocks to buy for you. And the cool thing is that once you reach the legal age in your state, the account's ownership will convert to you. Now, not all brokerage companies offer custodial IRAs. So I suggest that you sit down with your parents and you do your research before opening your account. Here are some companies that offer custodial accounts and the minimal initial investment requirement by each one of them. Now the question is, where do you invest your money? Should you just get out there and start buying your favorite company stocks like Amazon or Uber? You probably heard a million times that young investors should be taking risks, because if a young investor loses his money, they have more time to recover from those losses than somebody who's nearing their retirement age. And although that is somehow true, you shouldn't take that argument as an excuse to gamble your money just for the opportunity of a big payoff, because you might end up losing all your money. And when it comes to investing, not losing money should be your number one priority. And why is that? Let me illustrate it for you. Let's say you have an investment that is worth $100. If the markets drop 10%, that puts your investment at $90. Since it takes a $10 gain to get back to 100, you would need an 11.1% gain to recover from your loss. So if you lost 10% of your portfolio's value, you need to gain 11.1% to get back to break even. But the scary part is that the more you lose, the more you have to gain to get back on track. Take a look at the following chart. A 30% loss requires a 43% gain to recover. A 50% loss requires a 100% gain to recover. And a 90% loss requires a 900% gain to recover. So before I go into any investment, I always ask myself, how do I minimize my downside? And there's actually 3 ways for you to do it. The first one is by diversifying your portfolio. If you only own, let's say, Facebook stock, your entire money depends on that company. So if that company files for bankruptcy in the future and the stock tanks, you might end up losing all your money. So that's why I never put all of my eggs in one basket. So instead of owning 1 or 2 companies, I like to own a little piece of every company in the US market. So if some of those companies do bad, there are going to be others that are going to be doing well, and that's going to balance out, and I'm going to limit my losses. That's why I own the Vanguard Total Stock Market Index Fund, because it gives me exposure to the entire US equity market, which includes almost 4,000 companies. However, there are other index funds that emulate market returns of the Dow or the S&P 500 or the Nasdaq. I suggest you do your research and you pick the best one for you. I'm gonna leave a link down below where you can find different index funds for you to study and pick from. And moving on to the second way of minimizing your losses, you have asset allocation. Asset allocation is a way for you to diversify your portfolio by putting your money in different asset classes. In the previous example I gave you, your money would be diversified through 4,000 companies in the US. But if the US stock market crashes, you're going to end up losing a lot of money. So the way you offset that risk is by investing in different asset classes. You can invest in the US stock market, the US bond market, international stock and bond markets, in commodities, real estate, metals, and you can also money in cash. Normally when the stock markets crash, the bond market and the metals market tend to do well. How you allocate your assets is your personal decision. The asset allocation that works for you might change through different times of your life. And it depends on how long you have to invest and your ability to take risk. If you're young, you have a longer time horizon and you might feel more comfortable taking riskier investments. And as you get older, you may prefer to take on less risk. There's people who only put their money in US stocks and US bonds and like to keep a balance of 60-40 in their portfolios. 60% of it being invested in stocks and the other 40% invested in bonds. Well, there are going to be others that would like to diversify their portfolio by adding more asset classes than just stocks and bonds, which is what I do. If you wish to learn more about asset allocation, I suggest that you Google Ray Dalio's all-weather portfolio. And finally, last but not least, the third way to minimize your downside is by rebalancing your portfolio every year. And what do I mean by that? Let's say you have invested $1,000 in a 60-40 portfolio, 60% in stocks and 40% in bonds. A year goes by and you see a rise in stock prices, but the bond market is underperforming. So by the end of the year, your asset allocation might be 70% in stocks and 30% in bonds. So in order for you to reestablish your 60-40 asset allocation mix, you're gonna need to sell some stocks and buy some bonds. That's what rebalancing is about. The longer you've been investing, the more you're gonna see that some assets grow faster than others. And that might push your holdings out of alignment with your investment goals. So you're gonna need to rebalance your portfolio every once in a while. I personally like to do it every year, but then again, that comes down to personal choice. With that being said, we're done here and it's time for the bonus tip. Since you stayed watching this video until now, I have a little surprise for you, so hear me out. Another way for you to start investing is by using micro saving apps. These apps are gonna round up every purchase you make and automatically invest the difference for you. The one that I use is called Acorns, but there's a very similar one named Stash. If you're already using one of these, let me know in the comments below which one's your favorite, Acorns or Stash. And if you've never heard of them, the apps work the following way. After you create your account, all you need to do is connect your debit card or your credit card, and the next time you buy a Coke at a vending machine using your card for $2.50, the app will round it up to $3 and invest the extra 50 cents in the stock market. I personally have been using Acorns for less than 2 years and I already have just shy of $1,800 in my account. So why don't you try it out and give it a shot? With that being said, that's all that I have for today, guys. I really hope that you enjoyed this video and that you now have a better understanding of how you can start investing. If you're a teenager, feel free to share the video with all your friends so you can help them out. And if you're older, send it to a young person that you know that would benefit from watching it. Remember to hit the like button and subscribe to the channel if you want to be notified every single time I upload a new video. As always, thank you guys for watching. Until next time.